Hello, today in less than 5 minutes, KNG International Advisors will bring you up to speed on the international financial markets. This week's report is entitled, Why Currency Choice Matters as Much as Asset Choice. Trying to forecast where exchange rates will move next ranks among the more thankless exercises in finance, arguably harder than predicting equity markets because it demands getting the relative view right on two economies simultaneously, not just one. A currency's fate hinges on geopolitics, debt to GDP, inflation trajectories, interest rate differentials, bond yields, and sovereign creditworthiness, all interacting at once and often pulling in different directions. Yet for investors domiciled in countries with historically weaker currencies, ignoring this dimension of portfolio construction is not really an option. The current picture illustrates why. The Federal Reserve maintained the target range for the federal funds rate at 3.5% to 3.75% at its late July meeting, noting that economic activity is expanding at a solid pace despite elevated uncertainty tied in part to the conflict in the Middle East. A spike in gasoline prices resulting from the war with Iran pushed the annual inflation rate to 4.2% in May, its highest level in more than 3 years. That combination of firm rates and sticky inflation has kept the dollar attractive on a carry basis even as questions persist about America's long-term fiscal trajectory. Meanwhile, the dollar's dominance in global reserves remains largely intact, even if it is being nibbled at the edges. The share of US dollar holdings decreased to 56.77% in 2025 Q4 from 56.93% in 2025 Q3, a gradual drift rather than a collapse. The euro's share declined to 20.03% in 2026 Q1 from 20.38% in 2025 Q4, while the renminbi's share edged up to 1.99% from 1.95%. That last figure matters enormously for anyone entertaining the idea that China's currency is close to displacing the dollar. It isn't. A currency used by barely 2% of global reserves, issued by a state that controls capital flows and information alike, is not a serious alternative store of wealth for anyone prioritizing the preservation of capital over political conviction. For investors in Latin America, the calculus around dollar exposure is not academic. Argentina's national currency has fallen to its weakest level ever against the US dollar, marking another significant milestone in the country's prolonged economic struggles. The Argentine peso declined to its lowest value ever against the US dollar, extending a long-term trend of depreciation that has significantly reduced the purchasing power of households and businesses across the country. This is not a one-off shock but the latest chapter in a decades-long pattern, and it explains why dollar-denominated assets hold such appeal for savers who have watched their local currency erode repeatedly, regardless of whichever government happens to be in charge. It is tempting to assume this is purely an emerging market concern, but that would be a mistake. Sterling's recent history offers a useful reminder that G7 status confers no immunity. GBP USD rose 6.5% in 2025, but this was driven by US dollar weakness rather than by notable strength in the pound, and the USD index fell 10% across 2025, marking its worst yearly performance since 1979. In other words, sterling's apparent strength last year said more about dollar softness than pound resilience, and the pound remains exposed to bouts of weakness if political risk rises, growth concerns deepen, or rate expectations move again in the UK. A decade of political churn and lackluster growth has left the pound a less reliable store of value than it once was, which is precisely why even UK-based investors increasingly look to diversify beyond their home currency. Switzerland remains the standing counterexample, a small economy punching well above its weight in the wealth management world. Switzerland manages 25% of global cross-border private wealth, totaling 2.4 trillion Swiss francs in early 2026, a concentration built on decades of trust built on political predictability, currency strength, and legal confidentiality. The franc's low weighting in official reserve statistics disguises just how disproportionately it is trusted by private capital seeking a genuine alternative to the dollar and the euro. None of this amounts to a case for abandoning local currency exposure altogether, nor does it suggest the dollar is a risk-free bet given America's own fiscal strains. But for investors whose home currency has a track record of depreciation, whether that history spans decades in Argentina or merely a difficult decade in the UK, holding a portion of wealth in dollars, francs, or genuinely diversified international instruments is less about chasing yield and more about not putting every unit of purchasing power behind a single government's promises. Currency risk cannot be timed with any more confidence than equity market timing. It can, however, be diversified, and that distinction is worth acting on rather than debating indefinitely.